Welcome to this explainer. Today, we're diving deep into ASC 35020 to take a forensic look at the birth, life, and potential demise of Goodwill. We aren't just talking about balancing the books here. We're uncovering the literal DNA of corporate acquisitions and the very strict rules that govern them.
Here is our roadmap for today. We'll be hitting the birth of Goodwill, where it lives, the clash between book and tax rules, annual impairment testing, and finally, the red flags and risks you need to watch out for.
All right, let's jump right into Section 1, the birth of Goodwill. Think about it. Goodwill only exists because one company bought another. It is the ultimate financial leftover. You're paying a premium over the fair value of things you can physically point to. I mean, you can build a factory from scratch, right? Or code new software. But Goodwill? No way. You absolutely cannot build that internally. It only springs to life during a business combination.
So how exactly does this math work under ASC 350-20? Well, you have to follow a very specific sequence. You start with the total consideration, basically the total price paid. Then you add in the fair value of any non-controlling interest, plus any previously held equity. Finally, you subtract the fair value of every single separately identifiable net asset. And whatever's left over at the end of that, boom, that's your Goodwill.
Now, what if that calculation flips? What if you actually paid less than the net assets? First off, double-check your math. Seriously, true corporate bargains are incredibly rare. But if it's a genuine steal, you recognize the gain immediately in earnings. You never, ever create some weird ghost asset called negative goodwill. It just doesn't exist.
Moving right along to Section 2, where Goodwill lives.
So once it's born, Goodwill needs a home. It has to be assigned to specific operating segments or exactly one level below them. Basically, you're placing it wherever the actual synergies of the deal are expected to happen. And once it's assigned based on those expected benefits, it is locked in. It gets tested annually right at that very specific level.
But hey, you've really got to be careful here. Let's say your company reorganizes, which happens all the time, right? If you forget to update where your Goodwill lives, a failing business unit can literally hide behind a highly profitable one. It's a massive compliance risk. As your business evolves, your reporting units and your Goodwill assignments absolutely must evolve with it. Otherwise, you're totally invalidating your impairment tests.
Let's get into Section 3, Book versus Tax Rules.
This is where things get a bit weird. It's kind of a split reality. For public companies, you never amortize Goodwill on the books under US GAAP. It just sits there completely flat. But the IRS? Under IRC Section 197, they demand a 15-year declining schedule for Goodwill coming from asset acquisitions. So your book value stays sky high while your tax value is just steadily dropping down to zero.
And because of this divergence, it's definitely not a set-it-and-forget-it situation at closing. Your accounting team is locked into tracking these deferred tax liabilities for a solid decade and a half. That widening gap between the flat book basis and the shrinking tax basis, yeah, that requires constant computation, quarter after quarter.
Which brings us to Section 4, Annual Impairment Testing.
All right, so companies can actually save a ton of time and money using Step 0. This is an optional qualitative review of the macro environment and industry weather. Basically, you're asking, is it more than 50% likely that our reporting unit's fair value has dropped below its carrying amount? You'll look at things like cost increases, stock prices, industry shifts. If the skies look sunny, you pass and the testing stops right there. But, and this is a huge but, it is a glaring red flag to use this shortcut if your performance is already crashing.
So what happens if you skip Step 0? Or maybe you've lost key personnel, or you're severely missing your financial targets? Well, you can't rely on the qualitative test anymore. You are forced right into the brutal reality of the quantitative test.
Under the simplified ASU 2017-04 rules, the math is incredibly straightforward, but it's totally unforgiving. You just compare your fair value to the carrying amount. Is the fair value higher? Great, you pass. Are you underwater? Then you have to book that excess as a loss, capped at the Goodwill balance, of course. There's no complex Step 2 to hide behind anymore. That shortfall is literally your impairment.
To actually find that fair value, companies usually rely on a discounted cash flow model. And let me tell you, every single assumption you use here is going to be heavily scrutinized by the SEC. Your discount rate reflects your market risk assumptions. Your revenue growth and margin assumptions drive those forecasted cash flows. And that terminal value, that captures everything beyond the forecast. If your inputs here are overly optimistic, well, your fair value is just pure fiction.
And you've got to remember, Goodwill impairment is a strict one-way street.
Once you write it down, that value is permanently gone from your balance sheet. Even if the business miraculously turns around the very next year and your fair value skyrockets, U.S. GAAP strictly forbids reversing a goodwill impairment. No exceptions. That new, lower carrying amount? That's your new baseline forever.
Let's wrap up with Section 5, Red Flags and Risks. Picture this. A company dumps all of its purchase value into goodwill just to avoid amortizing things like customer relationships or tech over time. Regulators are going to step in immediately. This usually happens when a deal closes without bringing in a valuation specialist. Suddenly, the balance sheet is missing identifiable intangibles, goodwill is totally overstated, and future expenses are conveniently hidden. Honestly, it's a guaranteed recipe for a PCAOB comment letter.
Then there's the classic optimistic budget trick. When management uses overly rosy budgets to mask impairment, the real fair value gets buried. Think about it. If a budget was set during a massive high-growth phase, but now the business is facing serious margin compression, relying on that old budget is incredibly risky. You absolutely must step back, test those sunny assumptions against trailing, historical actuals, and run rigorous sensitivity analyses.
Delayed impairment recognition and outdated reporting structures, these aren't just minor clerical errors. They are often the highest-rated risks on a corporate register. If you aren't rigorously updating exactly where your goodwill lives, or if you hesitate to test when the market turns sour, you are carrying massive compliance and SEC enforcement risk.
So you want to keep a really sharp eye out for these 4 major symptoms. They almost always indicate that goodwill is artificially inflated. No intangibles identified, that's just a lazy allocation. Undocumented tests shows a complete lack of rigorous process. Using a step 0 qualitative pass when the business is actively declining, that's a glaring contradiction. And finally, assigning all goodwill to a single massive entity-level unit, that is a classic textbook tactic used to mask poor-performing divisions.
20%. That number right there is the target headroom you want for your goodwill impairment coverage KPI. Because if your fair value is only, say, 2 or 3% higher than your carrying amount, you are right in the danger zone. Having a solid 20% buffer indicates true health and gives you a very real cushion against any sudden market downturns.
So I'll leave you with this final, provocative thought to take back to your own balance sheets. If your company reorganized its reporting units tomorrow, would your goodwill still be justified? Or is a massive impairment currently hiding in plain sight? Understanding this life cycle isn't just a dry accounting exercise, it's absolutely vital for seeing the true underlying health of an acquired business. Thank you so much for joining this explainer. Keep learning, keep questioning the numbers, and I'll catch you in the next one.